Welcome back to Investing Talk Podcast.
Today we're looking at HIMS and HERS Health.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. HIMS and HERS Health has really cemented itself as one of the most, dynamic growth stories in digital healthcare right now.
It really has.
Their Q3 2025 results were frankly staggering. They show just how robust demand is for their platform. We saw revenue hit $599 million.
And that's the number everyone jumped on, right? That $599 million, it's a 49% year-over-year growth?
Exactly, 49%.
I mean, in a market where you see legacy companies struggling just to get double digits, HIMS and HERS is just accelerating way past them.
It really validates the whole bullish outlook on their direct-to-consumer model. It's clearly working.
Yeah, consumers are tired of the old way of doing things.
Yeah.
But growth is one thing. What about profitability? Because growth can be cheap.
And that's where the story gets really interesting. It pivots from just growth to operational excellence. They reported a gross profit of $442 million in Q3.
Okay, hold on, because that number translates to a gross margin of 73.8%.
A sector-leading 73.8%.
That is exceptional. I mean, when you compare that to anyone else in telehealth or even the big pharmacy benefit managers, it's just... It's in a different league. How are they doing that?
That's the key question, isn't it?
Yeah.
The secret sauce is all about supply chain control. It's why people call it fast fashion healthcare.
What does that even mean?
Well, most digital health companies are just a software layer. They connect you to a doctor who sends a script to an outside pharmacy. HIMS and HERS built its own network.
So they're not just prescribing, they're actually, manufacturing the product themselves?
Precisely. Or at least compounding and fulfilling it. They control the entire value chain from the consultation right down to the shipping.
So they cut out all the middlemen, the wholesalers, the retail pharmacies.
All of them. And that's how you get that incredible pricing power and maintain a 73.8% gross margin even with affordable subscriptions. It's a huge competitive moat.
And a massive data advantage, I'd imagine. They can track customer acquisition costs and lifetime value with perfect accuracy.
Exactly right. And zooming out, that model is clearly scaling. Their trailing 12-month revenue is up to $2.21 billion.
With net income at, about $133.8 million for the same period? It's consistent acceleration.
And they're using that scale to go after the biggest markets out there. They're not just sticking to men's health anymore. The real push now is into these massive segments like GLP-1s and testosterone care.
Okay, GLP-1s. That's the biggest story in pharma right now. It's also super regulated, expensive. Why do they think they can win there?
They're betting on democratization. The normal path to get these drugs is slow, it's expensive, you've got insurance hurdles, it's a mess.
Right.
HIMS and HERS uses its platform to connect patients to doctors fast, and then uses its own pharmacies to deliver affordable, often custom compounded versions right to your door.
They're basically bypassing all the traditional friction points. A brilliant move, but high stakes.
Very high stakes. But let's talk about the foundation, because you can't be that aggressive without a solid balance sheet.
Absolutely. So how does it look?
It's robust, very modest, manageable debt, which is so important in this rate environment. They have the liquidity to fund this huge expansion without diluting shareholders.
And that confidence really shows in their capital allocation, doesn't it? They just finished a $100 million buyback and then almost immediately announced a new one.
A much bigger one. A new $250 million share repurchase program authorized all the way through November 2028.
That is a massive statement to the market.
It is. It says two things. One, we think our stock is undervalued. And two, we expect to generate a ton of free cash flow to pay for this without slowing down.
Okay, so fundamentals are strong. Management is confident. What about the technicals? Is the chart confirming the story?
It is. After that great Q3 report, the stock entered a very strong bullish trend. You see textbook higher lows, higher highs, and crucially, it's trading comfortably above both the 50-day and 200-day moving averages.
Which confirms institutional buying, right? The big money is accumulating.
That's what it suggests, yes.
But is it getting overheated? What are the momentum indicators like the RSI telling us?
That's the best part, not yet. The RSI is in that constructive 55 to 65 zone. So strong momentum, but it's not screaming overbought, which can often signal a pullback is coming.
So there's still room to run.
The HCD signals also look good, confirming that accumulation. For traders, you can see clear support down in the $31 to $34 area and resistance up closer to $44, maybe $48.
Okay, let's pivot to catalysts, the near-term stuff. What could move the price in the next, say, 3 months?
First up is the Q4 earnings report. We're expecting that in late January 2026. Given the momentum we've seen, the consensus is for another beat.
And a beat would really validate this whole expansion strategy, especially into the new areas.
It would. And we're also looking for updates on their product pipeline. They've been talking about new at-home lab tests and, of course, the real scaling of their obesity therapeutics.
Those are tangible revenue drivers, not just stories.
Exactly. And beyond the company itself, you have to watch the institutional activity.
Right. Year-end and the new year are always big for that.
For sure. First, you've got ETF rebalancing in December. Then the really big one is the 13F filings window in January.
And for anyone who doesn't follow those, just explain quickly why they're so important.
They're mandatory reports from big money managers, anyone with over $100 million. The January filings will show us what the hedge funds and big institutions did after that massive Q3 report.
So you get to see if the smart money really bought into the story.
Precisely. It's a huge validation signal.
And then there's always the speculative stuff.
Yeah.
The rumors, anything interesting floating around.
The chatter is definitely lively. There's constant speculation about a potential strategic alliance in the GLP-1 space.
Like with a major pharmaceutical company?
It's possible. A big pharma player could use HIMS and HERS platform for distribution. An announcement like that would be huge for the stock.
And the rumors aren't just domestic, are they?
Correct. There's a lot of talk about international expansion, especially into European telehealth markets, which are still pretty fragmented. Their model could be very disruptive there.
Okay, we have painted a very bullish picture here. We have to talk about the other side. The risks. What's the biggest concern?
The valuation, plain and simple.
It's priced for perfection.
Absolutely. The forward PE is sitting at 58.2. That's not a multiple for just strong growth. That's a multiple demanding sustained hypergrowth.
So if they have a great quarter, but then guide for growth to slow down from, say, 49% to 30%, what happens?
A brutal correction. That premium valuation assumes they can keep up this pace. Any slip-up, any execution error, and that multiple will contract hard and fast.
And the execution risk is probably highest in these new complex areas, like the compounded GLP-1s.
Exactly. They are wading deeper into territory with a lot of regulatory scrutiny. Any negative headline about the quality or safety of their compounded drugs could be devastating for the brand.
And while they've been resilient, the whole telehealth sector is still exposed to macro headwinds, isn't it?
It is. If consumer spending really tightens, subscription services can be one of the first things to go. Now, their focus on chronic conditions does make their revenue stickier than most.
But it's still a risk.
It's still a background risk, for sure.
So bringing it all together, the disruption, the growth, the risks, what's the final takeaway?
I think the bullish case holds up because they are in control of their own destiny. That vertical integration gives them a margin advantage that's just undeniable. You have hypergrowth, clear management conviction with that huge buyback. It sets the stage for continued outperformance.
It sounds like it's attractive for both short-term traders playing the catalysts and for long-term investors betting on the future of healthcare.
I think that's a fair way to put it. It's for investors with a high risk tolerance who really believe in this consumer-centric shift.
Which brings us to a final thought for you to consider. Given that aggressive new $250 million share repurchase and their push into hyper-competitive areas like GLP-1s, how absolutely critical is their execution in Q4 for maintaining this premium valuation? And maybe more importantly, what level of customer loyalty will be needed to sustain that incredible 73.8% gross margin as new competitors inevitably try to copy their model?